In this fourth installment of criteria for consistency, we're going to be talking about risk and specifically risk, but also reward in terms of volatility using the ATR. So I'm going to make this video fairly quick because this will help us in our evaluating how effective our entries are, because we have a bona fide, consistent, easy to follow method of fixing our stops, setting our stops with no kind of subjectivity. It's there on the chart. It adapts to the volatility, and this is essential for consistency, because in the past I've found that when I've set arbitrary stops that I want, 10-point stops, 2-point stops, 10 tick stops in crude oil, or 2-point stops in ES, or I just kind of set a stop and then adjust the risk accordingly to how I want to risk on the account. It didn't work because it wasn't moving with the market. This is something dynamic that consistently and objectively adapts to the volatility. So we're going to have a look at apply these three criteria to the chart. I'm not going to talk about the specific entries of this system. I'm just going to choose random, semi-random reversal candlesticks. In front of us, we've got, highlighted by the ChatGPT, reversal wicks, BRW, let's call it indicator, bearish stroke bullish reversal wicks indicator. We've got the shorts highlighted here, so we'll use the shorts. Number one, R, the first things to go through, just to make sure we're on the right, we're all on the same page and we all understand the terminology. Number one, R in quotes, as you see there, is risk in terms, for the purposes of this video. In video 7, we're going to be talking about R in terms of dollar amounts or percentage amounts as it pertains to the trading account, but that's for that 7th video. So in this video, 1R is the risk in terms of pips, ticks, or points. So with the ES, I round to the nearest point. Each point has 4 ticks. So I'll never do like a 1.5 point stop. I'll either do a 1 point stop or a 2 point stop or a 3 point stop to make it easy and kind of give it some wiggle room, rather than going down to quarter points, i.e. ticks. As I said, there are 4 ticks in each point, so each tick is a quarter point. So that's one. Number two, R is determined by the last candle, and this is really important, the last candle before the entry candle. So when we find our entry candle, or as it's forming, we're looking at the prior candle as it's forming to give us the ATR reading to set our stop, and that leads us on. That's a great segue into number three. We are using the 14 period, and you can see it on the bottom of the chart down there. Let me just point to it, this down here. And I've got on the side of the screen, on another screen, I've got this data box which will show me the ATR here. As you can see, as I move along, it changes. We'll keep it here for now because we're going to need this in a second. Let me get that back for us, if I can find it. Just 1 second. I'm going to pause the video. Okay, there it is. We're going to use that. We'll do an example now. So we're using the 14 period ATR to give us the stop value rounding up. So with all three of these criteria in mind, let's move here. Let's say for whatever reason, we see this high up here. We've got the reversal candlestick, the BRW, as determined by our criteria in the ChatGPT indicator. On the close, which is right there because it's a red candlestick, so the close is 19 here. We're going to go to this candle, which is the candle prior to the reversal candlestick, and look for the value. As you can see, it says 1.1, so we're not going to go to 1.25 or 1.25 points. We're going to go all the way up to 2, and so the stop will go 2 points from 19, which is 21 right there. As you can see with this risk to reward tool, I've mapped out, I've got it set to a default of 2R, and we will get into all of this sort of thing in trade management in video 6. But for now, just know that this would be the stop, and then your target will, the important thing to know is that the target will always be a multiple of the risk unit, not, and I repeat, not a chart-based feature. So we're not looking to take out lows, we're not looking for bearish, we're not looking for fair value gaps, we're not looking for reversal candlesticks, we're exclusively basing our targets off of reward as a factor or as a multiple of the risk, and the risk comes from the volatility, hence the reason why the target is also volatility based, but it's just a multiple of that one unit of volatility, let's call it. So that's one there. Let's choose another one. Let's say here, this reversal candlestick, for whatever reason we choose, we break out of this little downtrend channel, and then it comes in once, comes in twice, and we choose this candle here. The close on this candle is 1550. The candle before gives us a 0.846 ATR, so we're rounding up to 1 point, because that's 0.846 points, we round up to 1. We get the risk to reward tool, 1550, go up to 1650. In the event that, as in this case, the 1550, the stop lands at the high of the bar, the reversal candlestick, or even within the candlestick, then we're going to look to get in so that we can get the stop above, and in this case we would have just missed the trade in that case. So let's look at another example. Let's choose something that might be a loser. You get in on this one, and that's 0.993, so we're going to round up to 1 again. Let's go here. The close is 1475, and that in that case we just hit the stop before moving to our in favor and coming back. So should we do one more? No, that's 7 minutes, so we'll end it there. You get the gist. We're entering on the close of the candle. We're making sure the stop goes behind the candle, so that's above for short bearish reversal wicks, and that's below for, such as this case, bullish reversal wicks. And we're basing that stop, we're using R determined by the last candle. We're looking at the ATR value of that last candle, and then that's going to give us our risk in terms of pips, ticks, or points for R as determined by the ATR. So that's this video. In the next video, we'll be looking at the entry model, and I've purposely done it this way because that way when we do the entry model, it's human nature to know whether the trade would have worked out or not. And now we know exactly how we're setting our stops and our targets, namely our stops, because then in next video will be video 5, in video 6, we'll be talking about trade management, which changes everything really, because depending on what you do with the trade, certain trades will lose, certain trades will break even, and certain trades will win. And that's for you to decide, but will give us some logic-based options, and I'll talk about what I do in that. But that's for video 6, I think that was, not 5. This is video 4. Video 5, we'll be talking about the entry model. So that's it for now. Take care, and we'll see you all in the next episode.